The rise of the Genius Act, key strategies behind the US dollar stablecoins challenge to global currency norms. Introduction. On July 18, 2025, the United States marked a pivotal moment in the regulation of digital assets with the enactment of the Guiding and Establishing National Innovation for U.S. Stablecoins Act, commonly referred to as the Genius Act. This legislation establishes a comprehensive federal framework for payment stablecoins, which are digital assets designed to maintain a stable value relative to national currencies, notably the US dollar. The Genius Act received strong bipartisan support, passing the Senate on June 17, 2025 and the House on July 17, 2025 before being signed into law by the President. The Genius Act aims to address several critical issues surrounding the emerging stablecoin market, including financial stability, consumer protection, anti-money laundering (AML) compliance, and the US dollar's status as a global reserve currency. This report provides a comprehensive analysis of the key provisions of the Genius Act and its anticipated impact on the global financial landscape. Key provisions of the Genius Act. 1. Issuance restrictions. The Genius Act imposes strict regulations on who can issue payment stablecoins in the United States. Only approved U.S. entities, referred to as permitted payment stablecoin issuers, can issue such digital assets. Eligible issuers include subsidiaries of insured depository institutions (IDIs), federally approved non-banks, state-chartered issuers meeting specific criteria. Foreign issuers may only participate if they operate under comparable regulatory regimes. This restriction aims to prevent the proliferation of unregulated stablecoins and ensure that U.S. issuers operate under stringent oversight. 2. Comprehensive regulatory framework. The Act establishes a clear regulatory framework that addresses concerns about financial stability and consumer protection. Key elements include reserve requirements. Issuers must back their stablecoins with high-quality liquid reserves on at least a 1:1 basis, ensuring that every issued stablecoin is fully backed by cash or equivalent assets. Monthly disclosures. Stablecoin issuers are required to disclose the composition of their reserves monthly, subject to examination by third-party auditors. This transparency is crucial for building trust with consumers. Redemption policies. Issuers must establish clear procedures for redeeming stablecoins, with disclosures on any applicable fees. 3. Anti-money laundering and sanctions compliance. To mitigate risks associated with illicit finance, the Genius Act imposes stringent AML and sanctions compliance requirements on both domestic and foreign issuers. This ensures that all stablecoin issuers maintain a level playing field and that foreign entities are subject to the same regulatory scrutiny as U.S. issuers. 4. Consumer protections. The Genius Act enhances consumer protections by granting payment stablecoin holders priority claims on reserves in bankruptcy proceedings, ensuring that these holders are among the first to be compensated in case of issuer insolvency. Providing a framework for the safe custody of reserves, which must be held in segregated accounts to prevent commingling with the issuer's assets. 5. Implementation timeline. The Genius Act takes effect either 18 months after its passage or 120 days after final regulations are issued, with a requirement for regulators to publish these regulations within a year. This timeline allows for adequate preparation by stakeholders and the establishment of necessary infrastructure. Implications for the US dollar and global currency norms. The adoption of the Genius Act is expected to significantly enhance the US dollar's position as a global reserve currency. Analysts predict that the integration of stablecoins into broader financial systems could reshape the US Treasury market. As of now, stablecoins hold approximately $128 billion in U.S. Treasuries, surpassing sovereign holders like Germany and South Korea. This figure could grow to $3.7 trillion by 2030, further embedding stablecoins in the economic fabric. Transformative potential of stablecoins. The Genius Act recognizes the transformative potential of stablecoins in the financial ecosystem. With transaction costs significantly lower than traditional payment methods, stablecoins are positioned to facilitate cross-border transactions more efficiently than ever. This competitive edge could lead to a broader adoption of stablecoins in everyday transactions from B2B invoicing to consumer purchases. Global impact and competitive dynamics. As the U.S. implements this regulatory framework, global attention is shifting to stablecoins. The Genius Act sets a precedent for other jurisdictions considering similar legislation, potentially leading to a race for regulatory clarity worldwide. The U.S. approach could become a benchmark for other nations, establishing a standard that balances innovation with consumer protection and financial stability. Conclusion. The Genius Act represents a landmark development in the regulation of digital assets and stablecoins in the United States. By establishing a clear framework for payment stablecoins, the Act aims to foster innovation while ensuring consumer protection and maintaining financial stability. As the stablecoin market continues to evolve, the implications of the Genius Act will resonate far beyond U.S. borders, shaping global currency norms and the future of digital finance. The passage of the Genius Act heralds a new era for payment systems, with significant opportunities for corporations, fintechs, and financial institutions to engage in this burgeoning market. As stakeholders prepare to adapt to these new regulations, the groundwork is being laid for a fully integrated and regulated digital asset ecosystem in the U.S., with the potential to redefine the future of money as we know it. The Guiding and Establishing National Innovation for U.S. Stablecoins Act, Genius Act, signed into law on July 18, 2025, represents a major regulatory shift in the landscape of stablecoins in the United States. This legislation introduces a federal framework for payment stablecoins, digital assets aimed at maintaining stable value relative to national currencies like the US dollar, and has garnered bipartisan support. Here are some counterintuitive aspects of the Genius Act and its implications for global currency norms. 1. Bipartisanship in digital currency regulation. While the regulation of cryptocurrencies and digital assets has often been a contentious issue dividing political parties, the Genius Act's bipartisan support is significant. This cooperation indicates a shared recognition across the political spectrum of the importance of establishing a regulatory framework for digital assets. Traditionally, financial regulations have been contentious, yet the urgency surrounding stablecoins and their implications for financial stability and consumer protection has compelled lawmakers to unify in support of the Act. 2. Consumer protection versus innovation. The Act's emphasis on consumer protection, including requirements for transparency and reserves backing stablecoins, might seem to stifle innovation. However, it actually encourages responsible innovation by providing a clear regulatory environment. This clarity can foster innovation as businesses will have defined parameters within which to operate, thus reducing the uncertainty that has previously hampered investment in the digital asset space. 3. Impact on foreign issuers. The Act imposes stringent regulations on foreign payment stablecoin issuers wishing to operate in the U.S. market, effectively leveling the playing field. It requires that foreign issuers comply with U.S. anti-money laundering (AML) and sanctions laws, which could be seen as a protectionist measure. However, this could also lead to increased competition and innovation as foreign entities are forced to meet U.S. standards, potentially pushing them to improve their compliance and operational efficiencies. 4. Stablecoins as a financial stability tool. Analysts have voiced concerns that increased reliance on U.S. Treasuries by stablecoin issuers could introduce risks to the Treasury market itself, as rapid redemptions may lead to a fire sale of these assets, adversely affecting their value. Conversely, the Act positions stablecoins as a stabilizing force within the financial system by requiring high-quality reserves and offering protections to consumers. This dual perspective, that stablecoins could pose risks while also serving as a bulwark for financial stability, challenges conventional views of risk in the financial ecosystem. 5. Shift toward digital asset integration. The Genius Act's provisions may lead to a significant integration of stablecoins into traditional financial systems which many might not anticipate. With major retailers and banks exploring their own stablecoin solutions, the Act may catalyze a transformation in how transactions are processed, potentially diminishing the dominance of traditional payment processors and bank transfer systems. The narrative that stablecoins are merely speculative assets will likely shift towards viewing them as foundational components of the future payment ecosystem. 6. Decentralization versus centralized oversight. While the Act establishes a centralized regulatory framework, it explicitly does not regulate decentralized finance DeFi protocols. This delineation could be seen as contradictory, as it creates a two-tier system where centralized stablecoins are heavily regulated while decentralized alternatives operate with relative freedom. This could foster innovation in decentralized systems, as developers and users may prefer to operate outside the stringent regulations imposed on centralized stablecoin issuers. 7. Potential for enhanced US dollar dominance. The Genius Act is poised to enhance the role of the US dollar as a global reserve currency. Analysts project that the total market capitalization of stablecoins could reach significant levels, which would mean that a portion of the dollar's supply is effectively tokenized, integrating digital assets into the global economy. This challenges the idea that stablecoins could undermine traditional currencies. Instead, they might reinforce the dollar's supremacy by making it more accessible and efficient for international transactions. 8. Financial inclusion through digital currencies. The Act's framework could paradoxically lead to increased financial exclusion, as smaller entities may struggle to meet the stringent requirements to become permitted payment stablecoin issuers. This could consolidate power among larger established firms that can afford compliance costs, countering the narrative of digital currencies as democratizing financial access. Thus, while aiming for stability and consumer protection, the regulatory burdens could inadvertently create barriers to entry for innovative startups and smaller firms. 9. Shift in market dynamics. As businesses begin to adopt stablecoins as a primary payment method, this could lead to a significant shift in consumer behavior. The expectation that stablecoins will provide faster and cheaper transactions could pressure traditional financial institutions to innovate and reduce costs. This challenge to legacy systems may not be anticipated by those who view stablecoins primarily as tools for speculation rather than as serious competitors to established financial services. 10. Regulatory arbitrage. While the Act aims to prevent regulatory arbitrage by requiring foreign issuers to comply with U.S. laws, it may inadvertently encourage entities to seek less regulated jurisdictions for issuing stablecoins. This could lead to a fragmented regulatory landscape where different jurisdictions compete for stablecoin business, potentially undermining the effectiveness of the Genius Act and leading to a race to the bottom in regulatory standards. In conclusion, the Genius Act's introduction marks a pivotal moment in the regulation of digital assets and stablecoins. The implications of this legislation extend far beyond the U.S., potentially reshaping global financial norms and the future of currency itself. The balance struck between innovation and regulation, consumer protection and market dynamics, will determine how effectively the U.S. can leverage stablecoins in its financial ecosystem. The contradictions and counterintuitive outcomes arising from this regulatory framework highlight the complexity of integrating digital currencies into existing financial systems while navigating the challenges and opportunities they present. Significant overlooked aspects of the Genius Act and their implications. The Guiding and Establishing National Innovation for U.S. Stablecoins Act. Genius Act, signed into law on July 18, 2025. Marks a pivotal moment in the regulation of stablecoins and the broader digital currency landscape in the United States. While many discussions focus on the Act's basic provisions and its potential to reshape the U.S. dollar's global standing, several critical nuances and implications are often overlooked. These aspects are significant due to their potential impact on market participants, consumer protection, and the global financial system. 1. Bipartisan support and its implications for future legislation. The Genius Act received strong bipartisan support, a rarity in contemporary U.S. politics. This consensus reflects a growing recognition of the importance of stablecoins and digital assets in the modern economy. The bipartisan backing may facilitate further regulatory advancements in the digital asset space, as it indicates a willingness among lawmakers to collaborate on complex financial issues. This unity could lead to a more cohesive regulatory framework that keeps pace with technological advancements, potentially positioning the U.S. as a leader in digital finance. 2. Impact on U.S. Treasury market dynamics. The Act anticipates a significant increase in the role of stablecoins in the Treasury market, projecting that holdings could reach $3.7 trillion by 2030. This projection raises several overlooked concerns, particularly regarding liquidity and market stability. As stablecoins increasingly back their value with U.S. Treasuries, rapid redemptions could create downward pressure on Treasury prices during periods of market stress akin to a bank run scenario. This linkage between stablecoins and Treasuries necessitates careful monitoring and potential adjustments to Treasury issuance strategies to mitigate risks of market disruption. 3. Regulatory certainty and innovation. By establishing a clear regulatory framework, the Genius Act encourages innovation among permitted payment stablecoin issuers. This regulatory clarity is essential for businesses to confidently invest in and develop stablecoin-related technologies. However, there is a risk that overly stringent requirements might stifle creativity and limit the competitive landscape. The balance between regulation and innovation will be crucial, as too much regulation could push innovation offshore or to less regulated environments, undermining the Act's goals. 4. Consumer protections and bankruptcy priorities. The Act includes provisions ensuring that holders of payment stablecoins have priority claims on reserves in bankruptcy proceedings. This consumer protection measure is significant as it enhances trust in stablecoins as a safe alternative to traditional banking products. However, the effectiveness of this provision depends on the transparency and integrity of reserve management practices. If issuers fail to maintain adequate reserves or comply with disclosure requirements, the intended consumer protections could be rendered ineffective, highlighting the need for vigilant enforcement by regulators. 5. Anti-money laundering (AML) and sanctions compliance. The robust AML and sanctions compliance provisions imposed on both domestic and foreign issuers are often underappreciated. By leveling the regulatory playing field, the Act seeks to prevent illicit financial activities associated with stablecoins. However, the practical implications of these requirements may pose challenges for smaller issuers and startups, potentially limiting competition in the space. Balancing stringent compliance with the need for a diverse and competitive market will be a crucial aspect of the Act's long-term success. 6. State versus federal regulatory authority. The dual regulatory pathways established by the Act, federal and state, are noteworthy but may lead to confusion and regulatory arbitrage. While this approach allows for flexibility, it also raises questions about the consistency of enforcement and compliance standards across different jurisdictions. The effectiveness of state regulators in maintaining equivalent standards to federal oversight will be critical in ensuring that all issuers operate under a uniform set of rules, thereby enhancing consumer trust and market integrity. 7. Inclusion of foreign entities. The provisions allowing foreign payment stablecoin issuers to operate in the U.S. under comparable regulatory regimes are significant yet often overlooked. This aspect of the Act could lead to increased competition and innovation, but also raises concerns about the enforcement of U.S. laws abroad. The challenge will be ensuring that foreign issuers adhere to the same high standards as U.S.-based entities, particularly in areas like AML and consumer protection, which could otherwise compromise the safety of the U.S. financial system. 8. Decentralized finance DeFi exemptions and future implications. The Act explicitly excludes decentralized protocols from its definition of digital asset service providers. This exemption acknowledges the growing importance of DeFi in the financial ecosystem but may also complicate the regulatory landscape. The lack of regulation for DeFi could create risks associated with consumer protection and market integrity, as decentralized platforms often lack the oversight that traditional financial institutions are subject to. The potential regulatory gap in DeFi could lead to calls for future legislation as the sector continues to evolve. 9. Technological standards and interoperability. The Genius Act emphasizes the need for interoperability standards among stablecoin issuers. This aspect is crucial as it can foster a more integrated financial ecosystem that enhances efficiency and reduces costs. However, the implementation of these standards requires collaboration across various stakeholders, including regulators, technology providers, and market participants. The challenges of achieving consensus on technical standards should not be underestimated, as differing priorities and objectives could hinder progress. 10. Future studies on non-payment stablecoins. The Act mandates studies on non-payment stablecoins, highlighting a proactive approach to understanding the broader implications of digital assets beyond payment functionalities. This consideration is significant as it signals a recognition that various forms of digital assets will play a role in the future financial landscape. The outcomes of these studies could inform future regulatory frameworks and shape the market dynamics for non-payment stablecoins, which may have implications for investors and consumers alike. In conclusion, while the Genius Act represents a landmark achievement in stabilizing and regulating the U.S. stablecoin market, the nuances embedded within its provisions hold the key to its long-term effectiveness. Stakeholders must remain vigilant in monitoring the implications of the Act's implementation, particularly concerning financial stability, consumer protection, and the interplay between innovation and regulation. As the landscape evolves, the lessons learned from the Genius Act will be invaluable in shaping future legislative and regulatory efforts in the dynamic realm of digital assets. The rise of the guiding and establishing national innovation for U.S. Stablecoins Act. Genius Act marks a pivotal moment in the regulatory landscape for digital assets, particularly stablecoins. Signed into law on July 18, 2025. The Genius Act introduces key strategies that not only reshape the U.S. stablecoin market but also challenge global currency norms. Here are the 4 most valuable points for in-depth analysis and discussion. 1. Comprehensive regulatory framework. The Genius Act establishes a clear and comprehensive regulatory framework for the issuance of payment stablecoins. This framework is essential for fostering consumer confidence and ensuring financial stability. By restricting issuance solely to permitted payment stablecoin issuers, which include U.S. banks and federally approved non-banks, the Act aims to mitigate risks associated with unregulated digital assets. In-depth analysis. The implications of this framework on innovation within the financial sector deserve close examination. How will the restrictions on who can issue stablecoins impact competition? Will it lead to a concentration of power among a few large institutions, or can smaller firms still find ways to innovate within the regulated environment? Additionally, the potential benefits and drawbacks of requiring issuers to back stablecoins with high-quality liquid reserves should be debated, particularly in the context of maintaining a stable financial ecosystem. 2. Enhanced consumer protections and financial stability. One of the core objectives of the Genius Act is to enhance consumer protections while addressing financial stability concerns. The Act mandates that stablecoin issuers maintain reserves that are at least equal to the value of outstanding stablecoins and provides clear redemption policies. In the event of bankruptcy, holders of payment stablecoins are given priority claims on these reserves. In-depth analysis. The prioritization of consumer claims in bankruptcy proceedings is a significant development that could change how digital assets are perceived. It raises questions about the nature of ownership and security in digital transactions. How will these protections affect consumer behavior and trust in stablecoins? Moreover, the potential for a run on stablecoins. Similar to traditional bank runs, presents an intriguing paradox. How can regulators ensure stability without stifling liquidity and flexibility in the market? 3. Global competitive dynamics and cross-border parity. The Genius Act aims to create a level playing field by imposing similar compliance requirements on foreign issuers wishing to operate in the U.S. market. This is particularly relevant as stablecoins gain traction in international transactions where regulatory arbitrage could disadvantage U.S. firms. In-depth analysis. The focus on cross-border parity raises critical questions about global regulatory alignment. How will the U.S. approach influence other jurisdictions in their regulatory frameworks for stablecoins? The balance between encouraging innovation and preventing illicit finance is delicate, and the Act's approach could serve as a model or a cautionary tale for international regulatory bodies. Additionally, what implications does this have for the future of the U.S. dollar as the global reserve currency, especially as other countries consider their own digital currencies? 4. Impact on U.S. Treasury markets. The Genius Act could significantly reshape the U.S. Treasury market, as analysts predict that stablecoins could increase their holdings of U.S. Treasuries dramatically, from approximately $128 billion to an estimated $3.7 trillion by 2030. This integration of stablecoins into the financial fabric of the economy could have profound implications for liquidity and market dynamics. In-depth analysis. The potential for stablecoins to become major holders of U.S. debt necessitates an exploration of how this would affect both Treasury yields and broader economic policy. If stablecoins were to dominate this space, how would that influence the U.S. government's borrowing costs and fiscal policy? Furthermore, the interplay between stablecoin reserves and traditional banking systems requires scrutiny. How might this shift the balance of power within financial markets and affect traditional financial institutions? In summary, the Genius Act is not just a regulatory milestone for stablecoins but a transformative force that could redefine financial landscapes both domestically and internationally. The implications of its provisions warrant thorough exploration, particularly regarding consumer protections, global competitive dynamics, and the future of U.S. financial markets. These discussions will be vital as stakeholders navigate the complexities of this evolving digital asset ecosystem. Here are 3 famous historical cases that are similar in nature to the rise of the guiding and establishing national innovation for U.S. Stablecoins Act. Genius Act. Particularly in terms of significant regulatory shifts and the establishment of financial frameworks that affected global currency norms. 1. The Glass-Steagall Act 1933. The Glass-Steagall Act was enacted in the aftermath of the Great Depression to address the financial instability that had led to the economic collapse. It established a separation between commercial banking and investment banking to prevent financial institutions from engaging in speculative activities that could endanger depositors' funds. The Act aimed to restore public confidence in the banking system and to create a safer and more stable financial environment. Its provisions included prohibiting commercial banks from underwriting or dealing in securities, which was an attempt to mitigate conflicts of interest and reduce systemic risk. Over time, certain provisions of the Glass-Steagall Act were repealed, leading to criticisms regarding the consolidation of financial institutions and the risks that emerged in the financial system, which culminated in the 2008 financial crisis. 2. The Securities Exchange Act of 1934. Following the stock market crash of 1929 and the ensuing economic turmoil, the Securities Exchange Act was established to regulate the securities industry and protect investors. This act formed the foundation for the U.S. Securities and Exchange Commission (SEC) and introduced regulations to promote transparency and fairness in the securities markets. The act required companies to disclose financial information to the public, thereby increasing accountability and trust. The creation of this regulatory framework helped to stabilize financial markets and restore investor confidence. The SEC was tasked with enforcing federal securities laws, overseeing the securities industry, and ensuring that markets operate fairly and efficiently. similar to the Genius Act's goals of establishing regulatory clarity and consumer protection for stablecoins. The Securities Exchange Act aimed to create a structured framework for securities trading. 3. The Dodd-Frank Wall Street Reform and Consumer Protection Act 2010. In response to the 2008 financial crisis, the Dodd-Frank Act was enacted to promote financial stability and protect consumers from abusive financial practices. The Act introduced comprehensive reforms to the financial regulatory system, including the establishment of the Consumer Financial Protection Bureau (CFPB) and the Volcker Rule, which restricted banks from engaging in proprietary trading. Dodd-Frank aimed to increase transparency and accountability in the financial system, reduce the likelihood of future crises, and ensure that consumers were treated fairly. Key provisions included stress testing for banks, enhanced oversight of derivatives markets, and measures to prevent too-big-to-fail institutions from jeopardizing the economy. The emphasis on regulatory clarity and consumer protection resonates with the objectives of the Genius Act, which seeks to create a secure framework for stablecoins while addressing concerns about financial stability and illicit activities. These historical cases exemplify how regulatory frameworks can shape financial markets and consumer confidence, similar to the anticipated impact of the Genius Act on the US dollar's status and the broader landscape of digital assets. The Guiding and Establishing National Innovation for U.S. Stablecoins Act Genius Act, enacted on July 18, 2025, represents a pivotal moment in the evolution of digital currency regulation in the United States. As stablecoins, particularly those pegged to the US dollar, gain traction globally, the Genius Act aims to bolster the US dollar's status as the world's reserve currency while ensuring consumer protection and financial stability. Looking ahead, several key predictions can be made regarding the implications and trajectories of stablecoins and the broader financial landscape influenced by the Genius Act. 1. Increased adoption of stablecoins across sectors. With the regulatory framework established by the Genius Act, businesses and financial institutions are likely to increasingly adopt stablecoins for various applications. Companies like Amazon and Walmart are already exploring the development of their own stablecoins, which could revolutionize how transactions are processed, offering lower fees and faster settlement times compared to traditional payment methods. By 2030, it is conceivable that stablecoins could account for a significant portion of daily transactions in sectors like retail, logistics, and even governmental payments, fundamentally altering the payment landscape. 2. Reshaping the U.S. Treasury market. The Act stipulations that stablecoin issuers must back their tokens with high-quality reserves, including U.S. Treasury securities, may lead to a substantial increase in stablecoin holdings of Treasuries. Currently estimated at $128 billion, this figure could rise to $3.7 trillion by 2030, positioning stablecoins as major players in the Treasury market. This influx of capital could enhance liquidity but may also introduce volatility, especially during mass redemptions. The interaction between stablecoins and Treasury prices will warrant close monitoring as market dynamics evolve. 3. Global standards and regulatory alignment. As the Genius Act sets a precedent for stablecoin regulation, other countries will likely look to the U.S. framework when developing their own regulations. This could lead to the establishment of international standards for stablecoin issuance and operation. Countries with comparable regulatory regimes may be allowed to participate in the U.S. stablecoin market, creating a more unified global framework. This trend could foster innovation but also raise challenges in terms of regulatory compliance and enforcement across jurisdictions. 4. Enhanced consumer protections. The Genius Act introduces significant consumer protections, such as prioritizing stablecoin holders' claims in bankruptcy proceedings. As these protections take effect, consumer confidence in stablecoins is expected to increase, driving adoption. This could lead to a new era in which consumers regard stablecoins not merely as speculative assets but as stable, reliable forms of payment. Enhanced consumer trust may encourage more individuals to engage with digital currencies, potentially leading to a broader acceptance of cryptocurrencies in everyday transactions. 5. Integration of decentralized finance DeFi and traditional finance. The regulatory clarity provided by the Genius Act could facilitate the integration of stablecoins with decentralized finance DeFi platforms, enabling more sophisticated financial products and services. As traditional financial institutions embrace blockchain technology and stablecoins, we may see the rise of hybrid models that combine the benefits of DeFi, such as yield generation and instant transactions, with the reliability of regulated financial services. This convergence could lead to innovative savings and investment products that leverage stablecoins for enhanced returns, further embedding digital currencies into mainstream financial practices. 6. Technological advancements in payment systems. The Genius Act is likely to spur technological innovations in the payment systems that utilize stablecoins. As businesses seek to optimize their transaction processes, we may witness the development of new blockchain solutions that enhance transaction speed, reduce costs, and improve security. The evolution of payment infrastructure will reflect the growing demand for real-time, efficient, and low-fee payment alternatives, prompting significant investments in fintech solutions that cater to these needs. 7. Emerging challenges and market volatility. While the Genius Act lays a strong foundation for stablecoin regulation, challenges remain. The potential for rapid redemptions and the market's reaction to Treasury price fluctuations may introduce volatility, impacting both stablecoins and the broader financial system. Regulators will need to remain vigilant and adaptable to address emerging risks while fostering an environment that encourages innovation. The balance between regulation and flexibility will be critical in ensuring the stability of the financial ecosystem. Conclusion. The Genius Act heralds a transformative phase for stablecoins and the broader financial landscape. As stablecoins become increasingly integrated into various sectors, the implications of this legislation will be profound. Businesses and financial institutions must prepare for a future where stablecoins play a pivotal role in everyday transactions, reshaping not just payment systems but also the overall financial architecture. The next few years will be crucial as stakeholders navigate this new terrain, driving the evolution of digital currencies and their place in the global economy.